Welcome to Trader's Edge, Tradier's podcast. I'm Jim Urio. That's Bob Iacchino. How are you today, Bobby?
Good. Are we supposed to get those Epstein names today?
We're not going to get the Epstein names.
I want to see the Epstein names. I want to
Isn't
see
it
how
funny
many.
how they tossed out Bill Clinton a couple days ago. The only guy that everybody knows for sure, of course. The flashing news, Bill Clinton.
Like that's a big shock. It'd be like if they announced Hugh Hefner was at his own party.
Exactly.
Same
Yes.
kind of thing.
I'm amazed that people fall for it. Like, finally we're right. Yeah, you've been right the whole time. Before we bring in one of our favorite guests, Art Hogan, Chief Market Strategist of B. Riley Wealth, I have a quick question for you. We've talked about the Fed pivot. Is the Fed pivot the only game in town for risk assets?
Yes, it is. Simply because it's been the only thing. Let me rephrase that. Fed policy has been the only real thing during the earnings recession that has driven stocks higher. And now we may have the earnings recession being over. Art would know that better than us, but it's been the thing that has driven markets. It's also been the things driven economies into recession, which clearly we haven't seen yet. What do you think?
Well, let's bring him in then.
Bring him in.
I thought normally when we do that intro, doesn't a picture of the guest then pop up? Does that mean Art didn't submit his headshot?
No, that's the other show.
Oh, that's the other. Oh, sorry about that.
That's the other.
How are you, Art? It's nice to see you.
We do two
Good to
shows.
see you. Thanks so much for
Art's
having
been
me.
on both shows.
What'd you say, Art?
Thanks so much for having me. And I love the first question. What a great place to start.
Oh, good. Yeah. So I guess that's what I've just been ruminating on for quite a while, because I've been, for 10 years really said Fed policy, how the cost of money is the key element of risk assets. And right now we're in a situation where the script is being flipped and they're going from a tightening cycle to an easing cycle. Is it the only game in town? And if not, what are the other games?
Yeah, and you bring up a really good point, but I think you want to think about the derivatives of monetary policy, right? So the clear headwinds for markets in 22 and 23 were a derivative of tighter monetary policy. So what was that? It was higher yields on treasuries. Clearly that became a headwind and played into cost of capital. But the other piece was the stronger dollar, right? So the stronger dollar and the significant increase in yields going from, call it 1.5% to 5% over a 16-month period, and then sort of backing up to 3 3/4 in October and November of this year, and sort of settling in at 4% today. That I think is one of the biggest pieces in terms of helping to bring back a risk-on attitude in markets. We saw that starting in October of last year, and certainly worked its way through into this year. I think the other piece of the puzzle that we can't ignore, though, is when you have the most aggressive monetary policy in the developed world, you're going to have the strongest currency, right? So, and the parabolic move up in the dollar was obviously going to be a headwind for earnings, especially for multinationals that make things in dollars and sell them in other currencies. So, and that makes up about 55 or 58% of the S&P 500. When you really think about that currency translation, that was a real headwind. So we've seen that pull back a bit. Yields are down a bit, and certainly the strength of the dollar, although we've seen 2 days in a row of a bounce back. But I think it's the derivative of the shift in monetary policy that I think really is the key to what may or may not be better earnings growth.
So there's one thing, because I want to talk about the dog thing too, but I realized I started the show without asking about the dogs. Are they Cavalier King Charles Spaniels? Is that what they are?
Yeah, and there was one that almost made the show. My son was nice enough to grab him like a second before the show started because he wanted to join. But I can't promise you the other one's likely to join. He's taking a nap right now downstairs where I do my work, and he's probably going to join the show.
We want him to join. We are pro dogs. I think I'm pro dogs. You are, Bobby, right?
Absolutely.
Careful what you wish for. Yeah. So
dogs better than people. Yeah, save for the two people on the show, of course.
Yeah. Ziggy's with my son right now, but Maverick is likely going to join us. So I'm just giving you full warning.
Well, is Ziggy like a Marley family reference?
Ziggy is a Marley family reference. And
are you going to see the movie when it comes out next month?
Yeah, I sure am. Yeah, and it's funny because I live in this area where there's an ice cream store called Ziggy's, and everyone assumed I named it after the ice cream store, which I didn't even know existed. So, I'm shocked how many times I was in the Home Depot. I was like, oh, Ziggy, is that after the ice cream store? I was like, no.
I would assume you own the ice cream store, and it was named after the dog.
Yeah, that's my plan B. That's my retirement plan.
So for just a quick quick 2 minute to 1 minute story. For the last 30 years, I work out young athletes at my house. We have a home gym and we work on plyo training and core training. I've done that for 30 years. But one thing that's always been consistent is we play Bob Marley music and as we work out. And I want them to ask why, because it's always like, because Bob Marley's a badass. Bob Marley took a bullet before he even got it out, went and did a 4-hour concert. He's a bad man.
Right. Absolutely. I love that story.
I want to challenge you on one thing you said a second ago about the dollar.
Okay.
You simplified it to be, we have higher rates. We started earlier. That's why the dollar's stronger.
Right.
To me, it seems like there's more to that too. Like, I mean, we are the United States, and we had Brent Johnson on our show, and he talked about, in all the world of nonsense, there's a lot more worse nonsense than us, right?
Correct. Right. So when you think about our economy, what drives it, certainly our demographics are better than almost all of Europe and certainly better than China. So the aging demographics not a problem for us. We certainly have a strong military that sort of backs up the full faith and credit of our dollar. So to your point, it's what drives our economy. And our economy is driven by a very resilient consumer. So 2/3 of our consumer continues to be the driver of GDP growth, and they're well employed. If they have a job, they're making a little more money this year. If they don't have a job, after today's JOLTS report, it looks like they have the ability to get a job. Their houses, went up and down. So we've got all sorts of things that drive our economy, and that helps the dollar. It's an oversimplification to say, to your point, hey, it's just because we have the most aggressive monetary policy. There's a lot of things that go behind the strength of the dollar, but it can also go too far, right? So that parabolic move that we saw in the summer and in July needed to be brought down, and that finally happened in October. Not coincidentally, that's when we saw the market reverse and start to run into the end of the year. Also backing up from 5% on the 10-year to 3 3/4 at some point in time, and staying within that band, I certainly think has been helpful as well.
So a couple of things are, number one, to your point and to Jimmy's point actually about the dollar and who we are and what the dollar represents. 2023, 1/5 of global oil actually traded in non-dollar terms. But the funny thing about that, because that was all over financial news, is that they still priced it in dollars. Right. They just had to convert it into another currency to make payments to each other.
What percentage did you say?
A full fifth. So 20%.
What was it 10 years ago?
Virtually zero.
Okay.
So, but I mean, it was priced in dollars, and then they had to convert it. So right. I would argue that's an even more difficult thing to do, just to transact away from the petrodollar. But having said that, to Jimmy's point, the dollar strength globally, can you go into the sort of relationship between equities and the US dollar? Because I think that gets lost on people, because is it more of a three-headed monster, to your point about rates and the dollar?
Yeah, it certainly is. And that's the thing that doesn't get enough of the attention. I think when you think about the movement of the dollar, you have to think about the companies that actually have to transact in other currencies. And that's the large majority of the S&P 500. So our biggest companies actually sell things, more overseas than they do onshore. And when you do that, there's it's a currency translation that actually impacts earnings, right? So it's when you think about the impact on earnings, it goes something like this. For about 60% of the S&P 500, a 5% move and the strength of the dollar, which is a massive move, but we saw that on a year-over-year basis heading into the middle of July, translates to something like a 7% degradation in earnings for 60% of the S&P 500. Now, you hope that you kind of get that back. You hope that there's ways to hedge that, and you guys know better than I do. Hedging that is expensive, right? You're still paying something to do that, but there's a very close relationship to the strength of the dollar and how multinationals do. And as that comes off, that benefit accrues to their earnings as well. And so clearly, we always want a strong dollar, and no administration is ever going to say you don't want a strong dollar. Corporate America would love to hear that, but you don't want it to go parabolic. You don't want to have the kind of massive moves. And you guys know that the currency moves are incremental versus moves that we see in equities and fixed income and commodities, et cetera. But the kind of move that we saw last year was eye-popping. And I think the fact that has calmed down is certainly a new tailwind for this market. It certainly started in the fourth quarter and hopefully continues, or at least has plateaued here. We've seen the peak. We don't have to see it go back down. We don't have to see the Dixie go, below 100 certainly, but hanging out at 108 was certainly getting, pretty precarious for a lot of companies trying to figure out how they're going to adjust to that.
So About the dollar. So I view all these moves this week, and I know Bobby and I probably think a lot shorter term than you do. So just this week, the dollar's bounced higher, gold's gone lower, stocks have gone lower, interest rates have gone higher. To me, it seems like it's all just part of a market positioning move. Everything had run. So like in the 2-year, the move from 5.22 in late October to 4.25 or whatever it was on the low, that's a hell of a move. The only move bigger than that in the 3-year period since the COVID stuff was when SBB was going under. That was the only bigger low rate move. So I personally think that this is market position. I think the move in stocks could have some more legs to the downside, 9 weeks of higher too. But my point was going to be is that when you look at those auctions that went poorly, do you think that there are some dollar weakening policies that could affect gold, silver, things that are very, very susceptible to dollar moves lower?
Yeah, that's a really good point. And what it really comes down to is, has the market gotten to a place where it accepts the amount of issuance the Treasury is going to have to put out? And that's, on a year-over-year basis, much larger. And clearly we realize what the effect of that has on issuance. And then certainly when you see how the auctions go off, and obviously we haven't had a failed one, but there's been some that have gotten some pretty poor grades, right?
Yes.
Right. So, and what's interesting about all of that is that it's happening at a point in time where we need to continue to issue more, right? And you've got a Treasury for one reason or another that continues to lean more on the short end than on the belly of the curve in terms of issuance. I don't know if that's out of necessity, if that's what the prime
fear.
Yeah, or what the prime dealers are telling them, that this is what we can sell, right? So we went back, and I know we talked about this maybe the last time we were on, but one of our clients happens to be also the head of the House Finance Committee. And I posed him this question. I was like, hey, interest rates are this low. At what point in time did you guys think about issuing more 30 years and 50 years and floating the idea of a 100-year out there? And his answer was just this. We survey our prime dealers, right? And we go to that group and say, what can you sell? And there was no uptake for it of any size whatsoever. They can barely get the 30 years off, right? And the 10-year is just doing okay. And that's why they issued so much in the front end of the curve and in the belly of the curve and nothing on the back end of the curve. So for a period of time, we're going to have to continue to watch that and say, okay, issuance is going to be front end loaded and it's going to be larger, and it's going to, we're going to watch every auction. And a year ago, we never looked at Treasury auctions. In the 30 years I've been doing this, I don't know how many times I ever talked about how a Treasury auction went until this year, right? So now it's been thrust upon us, and it becomes an issue that we have to watch closely because we know the amount of issuance that we have because of the amount of debt we have at higher rates is going to be, an ongoing issue. So yeah, that's going to affect movements in the dollar for sure. I think that's one of the pieces, that's a part of the matrix that makes that up, but I don't think it's the only piece in terms of dollar strength.
All right, the risk of using a word that we hate, let's pivot to equities. And we have you on our first live show of the year, and I think that's an opportunity to ask you, even though you're not a market timer, is to what basically are you looking for in 2024 in terms of performance? And you could classify it as risk-adjusted performance or just performance.
Right.
I think sometimes it's lost on people that if you lose less, you're outperforming. So if markets turn sour, what's going to protect you, and what are you looking to outperform next year?
Yeah, well, a good place to start with that is to look back at 23 and see how things went, right? And I think we can all agree that things went better than had been anticipated when we started this year. If we were doing this at the end of 22, I would probably be out on an island telling you that I think we're going to have a pretty good year. Certainly not as good as we had, but much better than 22. And a lot of that was sort of making up for what we lost in 22. Here we head into 23, and on a 2-year basis, returns haven't been spectacular, but we're coming off a 12-month basis where they have, right? And it's funny when you flip the calendar, everyone thinks, okay, we've got a fresh, clean sheet here. And we really don't, but that's the way our world works. So when I laid out what I thought markets were going to do at the end of November, the first part of December, I said, our estimate for earnings for the S&P 500 is about $250. It's about $4 above consensus, but estimates are always low. And if we use the same multiple that we've had on a trailing basis at the end of this year for that kind of earnings growth, you'd see the S&P 500 working its way up to, call it 5,100, 5,200, so an 8% year, a normal year of returns, 10% if you include dividends. But that's not going to happen in a straight line. And I'll tell you why. We just came off a tremendous year. I would argue that the juxtaposition of people that waited to sell for tax purposes until this year is starting to show up, and I think it's swamping the new money that's coming into retirement accounts and pension funds. That's why we're seeing the kind of activity we're seeing now. I certainly think that profit taking in the Magnificent Seven and a lot of technology stocks, communication services stock, et cetera, was put off until this year and probably shows up in the month of January. So I'd expect a lot of volatility here, and I think that's normal, right? So I think it's okay to say, hey, I did really well this year, and pick any of the Magnificent Seven stocks and had a record year. Where should I go now? Because what hasn't worked? And I think that's going to be the biggest theme in the first quarter of this year. It's going to be, what should I be sponsoring now that didn't have sponsorship last year? We're starting to see that already in healthcare. And that's one of the three sectors we really like on that chase trade, or that mean reversion trade, or that catch-up trade. And the reason healthcare didn't work last year was, unless you had a GLP-1 drug, if you had a weight loss drug, you were ascribed a huge multiple. Everything else got ignored. We saw the exact same thing in 20 and 21. Unless you had a vaccine, everything else was ignored. So healthcare on a multiple basis, on a price basis, looks spectacular and was largely ignored last year. I think that starts to get some of the attention. Away from that, we see the same thing in financials. I think financials largely ignored this year. They're in the bottom 5 of the performing sectors in the S&P 500. Again, I think that gets sponsorship. And then, the third one I throw in there, just to say it underperformed last year, but likely has better performance this year, are industrials. Doesn't mean you have to throw away all of your technology exposure, but I would certainly trim back any of your technology exposure if it's a too large a portion of your portfolio right now, because it just doesn't make sense. It's not going to have another north of 50% performance this year. It's going to have a good year, not a great year.
So 2 sort of follow-ups. Number 1 is to something you said, financials. You may like them. You're saying, you're not necessarily saying that other people should like it. You're saying you might like financials going in because of the underperformance. Do you get any pause in that from the fact that we're basically 10 months out of a bank failure? And that just doesn't seem like enough time to me. Right. And then the second thing I wanted to ask you, and then I'll shut up, in terms of, so I think 2024 might start to feel like sort of a reflationary year where growth accelerates and inflation re-accelerates. And if that's correct, when you look at an equity market backtest, energy is one of the better performing sectors in that kind of environment. And last year, looking at the XLE, energy was down almost 7% on the year. So does that pop into your radar at all?
100%. It definitely falls into one of those categories of underperformers that likely gets some attention this year. And I think it does for several reasons. So right now, if you look at the energy sector, right, they're quite profitable, right? The U.S. is producing more than it ever has. Mm-hmm. Brazil just joined OPEC Plus. So the cartel has even more influence, although they're going to lose, some of the African nations because they don't want to be held to the quotas. They need to produce as much as they can. But right. if you put all of that together with the dynamics of China likely coming back with more demand in the back half of this year as they continue to stimulate their economy, I think you've got for the first time in 16 months, a better balance of supply and demand in energy product, right? Well, right now we're oversupplied. And that's the reason OPEC, continues to stick to their quotas and they extend them out. And they've been very good at doing that, and compliance has been very good, but it's hard to continue to do that. And if you get that sort of that increase in supply that comes from both the U.S. and the folks that have left the cartel to meet up with China demand, I think you've got a price per barrel of oil that likely can hang out in the $75 to $85 versus the average closing price last year, which was $75 on WTI, which was lower than the year before, and likely the reason we saw a lot of the underperformance in the sector. So you've got a higher commodity price, you got more profitable energy companies, especially North American producers. You certainly have the ability to look at these things and say on a valuation basis they look very attractive. So on our dividend list and on our focus list, we have 3 energy companies, and that's 3 out of 12 on our focus list. Okay. I think it's a sector that we're really going to like.
You just mentioned the word dividend, and back in, I think it was October, when I first realized that the pivot was coming, one of the first thing I did was look for dividend stuff, thinking that they were going to rally, and I've done okay on that. That BlackRock has that advanced dividend. I'm not suggesting anyone buy anything, but I've had of that for a long time, and it pays you out like 9%. But anyway, that's not the point. The point is that I heard you say that I haven't heard many people talk about dividends in a while, right, when rates are at the level they are. Now, all of a sudden, do you think that's going to be one of the major shifts of 2024? Is people going to be looking at dividends again?
I think you have to start looking at dividends. Now, think about all the people that sort of took advantage of the front end of the Treasury curve and, moved into, what was a risk-free, shorter-term trade. And when that 3-month or 6-month or 1 year rolls over, what do you do with that? Do you do it again and ratchet down the yield that you're getting because that's going to continue to ratchet down, we believe, or at least it's not going higher, versus looking at the value that we see in dividends that has gone much higher than their averages. So, for example, if you look at some of the drug companies, right? Pfizer's a great example. It's been kicked in the teeth since they're no longer selling, billions of vaccines. So its valuation is down. It's throwing off a 5.5% dividend for a company that's got, free cash flow that's amazing and won't cut it, and has, 82 other products besides their COVID vaccine. So I think you start looking at things. I think you say to yourself, okay, what's this company's ability to continue to pay this dividend? And do I do better, finding something that's throwing off 3.5% to 5% in a dividend versus continuing to roll this money in the Treasury market, thinking that these higher yields are going to continue to be with us forever. And that's the way we're kind of looking at it. We've got about 8 names on our dividend list, and the average dividend is paying about 4.25%, which is not a bad return for companies that are pretty safe and been, part of the dividend darlings for a long time.
So I've been trading bond futures for better part of 30 years. And I had never actually bought a bond until 2023. I remember I got to buy bonds. I'm like, wait, do I even know how? Anyway, so the point was your clients. So I did buy a lot of short term. I bought 3 month up to probably 1 year, and I didn't go any further than that. And I like the fact that you said most people are parking their short term money. You didn't see a lot of retail, or who are if your clients are retail, but a lot of like your clients, were they looking to lock in 10-year at 5%, or were they more concerned with 1 year?
I would say the vast majority was looking at the short end of the curve, saying, okay, this is unbelievable. Why wouldn't I do this for a year or 2 or 6 months? And so I would say on average, if you talk to the guys on our bond desk, the most traffic they were getting on the Treasury side was a year or less.
Right.
And we got to a point, probably in the middle of the summer towards entering into the Labor Day weekend, where people started that conversation about, hey, do you think we need to extend out duration? And for the most part, nobody really said, okay, yeah, that really makes sense, because we're starting to get the sense then that, the rate of inflation is coming down enough. The Fed's already done too much. The likely next thing that they're going to do is what they eventually did in December. So I think we were very fortunate to have people thinking the way you were thinking, saying, this is a great deal. How can I pass this up for a year or 6 months, or, all along those lines? We also had a lot of people who went to Treasury Direct and now are saying, what am I going to do now with my Treasury Direct that's locked in for 5 years, right? And remember those amazing yields you got, the inflation plus. And so the Treasury just did something interesting this week, where they came out and said, we're going to be Treasury, and then they're adding 1.5% to that. So you still get, so what would that be, 4.5%? But you're still locked in for 5 years. So it's one of those things, and you can only do, I think it's like $25,000.
It was only 10,000, I thought. That's why.
You may be right. Yeah, I just know.
Yeah.
We had, I can't tell me how many phone calls I yielded on. I had to field on something I had nothing. I had to learn about it like overnight. Say, okay, here's what it is. And 10,000 is probably right, but it was just like one of those phenomena. It's like, hey, do you know we can do this? It's like, yeah, we can't do it for you. So
my daughter is an accountant and a financial person, and she's the one, because Illinois was paying like 8% or something for kind of 10, but it was only 10,000. And then I should have done it. Free money is free money, even if it's not a huge amount. But I didn't do it. Bobby?
With Illinois, I'd be worried about the return of my capital as opposed to return on my capital. But
you knew that was coming.
Exactly. So you work at a wealth management firm. Right. And so I assume that means that you manage wealth as part of your job. Is that fair to say?
Yeah. So it's in a couple ways to think about this. So think about the fact we have at or about 1,000 financial advisors, that have at or about 30 billion in assets under management. So I help framework how they should think about the world. So I do that in multiple ways. I have a morning meeting every Monday. I have a different discussion every Wednesday, and everybody can dial in. So that's more what's going on. Monday's usually about what happened last week, what new narratives are popping up and what to look out for this week. But we also put together portfolios. So we have internal portfolios that you can actually invest in. So we're actually managing that. There's probably about $500 million in that. Then we put together a focus list. So if you're the kind of portfolio manager that doesn't want to just sub out to an advisor, another manager that's going to run that for you and just collect the fee, that will help you build portfolios with that. So we have both a growth portfolio and a dividend portfolio. So that's the function of being a strategist when you're in a wealth management firm.
Okay. So for the most part, you get calls from advisors not necessarily from the clients directly.
Yeah.
So that's perfect for this question. That's what I wanted to know, because how many of those people, say during October, November, December, called and said, hey, should we be looking at gold? And how do you take that question when people ask you about gold?
Yeah, I wish that I could tell you how many questions I get about gold. And it's interesting because
Is the number too high or too small?
It's very high. And it's
Yeah.
very high for a lot of reasons. It's very high because there's, I would say 50% of the people that you work with, I would argue, and this has probably been true over 30 years, are fans of gold for one reason or another. It's something that fits their personality. It helps them sleep at night. It's one of the things that they believe in. And it has been around for thousands of years, right? So, and the way I think about it, and have expressed this, in different conversations that I have, has been relatively consistent. First and foremost, I'm never going to stop somebody that wants to put money in gold in anybody's account if it helps them sleep at night. And whether that's 3% or 5% of a portfolio, that's very good insurance that helps you feel better about yourself and what's going on in the world. So whether it's geopolitical turmoil or political division, or it's you're worried about the value of the dollar or the currencies or potential for inflation, all of those things, if this helps you feel better about it, I think it's a great place to be. The other thing I said was, let's look at the chart then, right? How long has it been trying to get to this level? How broad a base has this built? And oh, by the way, this year it was doing, this broad base and bumping up against, what had been resistance, while the dollar was still relatively strong. And then when the dollar rolled over, that's when it broke out. And I said, this is something significant. This is a very long base that this is built. So technically, I think this is a great time to get in. Understand there's going to be volatility around the asset class, but I certainly think that when you think about it as that security blanket, I can't think of a better time to buy it, because it's really been working towards this level for an extended period of time. It's built a very broad base. The dollar pulls back a little bit. That certainly helps, but we're certainly not going to have less insecurity about what's going on in the world.
So I have a quick question about gold. It's more of a statement that I want you to comment on too. Bobby mentioned before that now what percentage? 1/5 of petro of
20%.
Right.
Yeah, 20% of those transactions are not in dollar currencies. Central banks around the world over the last year and a half have shown pretty amazing thirst for gold, something that we haven't really seen in 75 years based on the net amounts of gold. I am not the dollar's going to hell, we're going into hyperinflation. One thing I've tried to explain to people before, and I want you to comment on it, is that if the scenario of the dollar going to shit goes from a 2% probability to a 10% probability, it's still a low probability, but there will be other people, and this is the way markets perform. Other people start to think that. That's why I buy gold. So it's hard to explain to people. I'm buying gold as a hedge against the dollar going to shit. And they're like, well, you think the dollar's going to shit? No, but I think other people will think that. That makes sense, right?
Yeah, no, that's absolutely the way you have to think about this, right? Because that's actually exactly what moves markets, right? I think that, there's a potential for a continuation of the trade that Bobby was talking about earlier, where more petrodollars are non-US dollars, right? And there's obviously a reason for that. Like, think about the fact the oil producers that don't like us and the oil consumers that don't like us necessarily, right? So, we put sanctions on Russia, and they didn't miss a beat because they're able to sell to places like China and India, right? So, people that didn't care about our sanctions. That's going to be the natural place for people to say, well, why are we doing this in dollars if we're doing this because these guys are forcing us to do this? And oh, by the way, we're forcing them to buy oil at lower prices anyway. I think that can continue because not every oil producing country in the world really loves us, nor does every oil consuming country. So that's, I think, where that percentage comes from. But I don't think we ever get to a place, and I don't know what would replace it, where there's a currency that's developed that's going to replace the dollar. So to that extent, I think you're betting against something that likely isn't going to happen. But if enough people are betting against the opportunity for that to happen, it's going to be a positive for the commodity, and precious metals likely do better. And
one more quick follow-up to that. Yeah. How tall are you?
5'11".
5'11", okay, because I was about to say, when we were talking about the dollar, the world's tallest midget, which is offensive to Bobby and I, because we are some of the world's tallest midgets, but you're not in our group, I don't think. Bobby?
Yeah, no, it's interesting when we talk about that. I brought that up as more a point of how ridiculous it is to even look at that, in my opinion.
Right.
Is to even think about the dollar going away because 20% of global oil traded a commodity that was based on the dollar but they just didn't actually convert to dollars to transact, which quite frankly, I think if you looked at the amount of times that something based in dollars that actually happens in, you're essentially settled in dollars anyway, because you have to settle to the current price. So if somebody is hedging, they're about to complete a crude oil transaction that is outside of the US dollar, they're likely still hedging in dollars, simply because that's going to drive the price up or down from that perspective. But, going back to gold is interesting, because I think when we talk about gold, and I'd like you both to comment on this if you could. I don't know if you guys saw that Ken Fisher article about why gold is bad. It kind of made the rounds, and he basically was comparing gold to equities and how equities always outperform gold, and how gold, got to a level and then took 8 years to get back there. And, I started thinking about this. I actually have a client that asked me to counter it. And I said, well, I don't want to counter it if there's nothing to counter, right? I mean, if Ken Fisher's correct in what he says, I'm not going to say to this client that I'll counter it, because I'd be making shit up, right? Now, I started looking at it and I thought, it's interesting when you look at when gold has outperformed, or when it's performed, I should say, because even in a lot of these times it didn't outperform. The 500% rally started after 9/11, basically, right? And it continued through, when was it? To about 2012 before it got to its peak, right? And then it came off from there. And if you start to think about sort of the global situation after 2012, got through 9/11, we got through a credit crisis, and things went calm on the geopolitical stage. And so I asked both of you, and this is part to help me craft this video and article if I end up doing it. Do you think that we're entering a period that's more like 2001 to 2012, or more like 2012 to 2020 pre-pandemic, which is when gold struggled to get back up to its old 2011 highs?
Yeah, you know what? That's such a great question, and I love the way you frame it, because you're really talking about a period of time, over an extended period of time, where we just went through some massive upheaval, right? And we're uncomfortable about a lot of things, and then you sort of follow that with a period of time where things were relatively placid, notionally, and then you roll into, okay, what does the world look like today? And I would argue that there is as many, if not more, geopolitical hotspots happening in real time right now that have people concerned, on top of other things that people are concerned about. They're still concerned about all sorts of things that have to do with the economy, inflation coming back, etc. But layer on top of that a war. You've got the brutal attack by Hamas on Israel that feels like it's leaving the region and spreading out a bit as we look at what's going on in the Red Sea, and the potential for Iran to get involved, which obviously brings ugly things to all sorts of things. And the fact that a war in Ukraine, brought on by Russia, that we thought would last 3 months, is in its second year, right? And the potential for that to get worse before it gets better. And it doesn't feel like we've seen anything close to an exit ramp in that situation, and how that could get worse, right? So I think that when you combine those two things that are happening in real time, and not knowing what China's going to do in Taiwan, and layer on top of that the other things that make you insecure about the world, I would say that we may well be entering in what might be more reminiscent of that post 9/11 into 2012 timeframe than that 2012 up until this year, when we started to sort of see the commodity work its way higher.
So
what do you think, Jimmy? I mean, going back to the point about the Illinois bonds,
a slightly different bent, slightly different angle, but it's related, because just today I was punching up a chart of public debt, the national debt, and if you break it up over the last 40 years, like the slope of increase in the national debt for 10 years goes like this, then for the next 10 years goes like this, and then for the last 3 years has gone like this. That scares the shit out of me. When Janet Yellen came out and said, she's responding to the question, can we afford to financially support 3 wars? I don't know if she was talking about Africa or if she was talking about China, Taiwan. And she's like, we certainly can afford 3 wars. I'm thinking to myself, you can't even afford peace. Jesus Christ. The national debt is going through the roof. This represents poor stewardship of our currency to me. So it's not necessarily the global conflicts that are driving me to gold. It's the chance that instead of don't want boots on the ground, because the Democrats, they've turned into war hawks, but it's only war hawks with a checkbook. It's not war hawks with boots on the ground, which I'm, I guess, glad of. But all the MMTers over the last 10 years, modern monetary theorists, were like, yeah, no, we can go much higher in national debt. We can go much higher in national debt. Well, where's the drop dead point? Because we're pointed pretty high right now. And again, I don't think the dollar is going to collapse. I agree with Brian Johnson. I do think this could happen. that as the Treasury exhausts demand on the short end, which we've said before, they're issuing on the short end. They exhaust some of that demand, and then they start to head out the risk curve, which they tried to, or the duration curve, and they tried to do that last week in the 7-year, and it went poorly. They start doing that. The Fed sees that the Treasury is jacking up long-term rates by the sheer weight of the issuance, and then the Fed comes back in with QE. I think that could be the signal that we have bozos in charge, and their stewardship is very, very poor. Again, I don't think, like I said before, I'll go back to it. Do I think that's my base case? No. Do I think it's a case to worry about and have gold in case it happens? Yes. So do you guys think?
No, that's fair. I think you'd lump that into the other things you'd be concerned about, right? The poor fiscal condition of our country, our inability to sort of ever balance our budget, the amount of overspending we did because of the pandemic, and for whatever reasons that and you sort of pile that all together, it's put us in a very precarious position, right?
Good.
Something
I'm glad you think that too. Yeah.
can only be fixed two ways, right? Either you cut spending or you increase your intake, right? And there's no popularity for either one of those things in the current political situation we're in. Maybe that changes after an election year, but the fix is you either have to spend less or you have to make more money. And to make more money, you have to either raise taxes or have a significant uptick in GDP. So there's going to be a reckoning at some point in time. I don't think we're knocking on the door of that, but to your point, that's one of the things you pile onto the things that would drive you into gold.
And I will say this too, because people, it's so funny how you're a Republican apologist. This. No, the only time Republicans ever complain about excessive spending is when Democrats are in office. As soon as Republicans take over, they spend like drunken sailors as well, and nobody says a word because Democrats never say it. So the only time there's an adult is when they can't stop the spending. It's complete bullshit. Sorry about that, Bobby.
No, it's okay. And I like what you said there, because really my point of asking you guys that question is, I think Art answered it the way I intended to ask it, was that is it geopolitically? Like, are we stressed out about things other than the financial circumstances, which I think is what gold needs to outperform. Now, having said that, I think we all agree that market timing and investing is a fool's game, right? But Jim and I both trade short term, right? And Art, you tweak portfolios now and again based on larger pictures. Now, when we trade short term, we have defined stops and defined targets and what we're going to do in certain circumstances. And this is why I asked that question about gold. And to your point, Jimmy, about let's add to that question. I think you already answered it. Do we see debt getting better or worse? And I see it getting worse. And what interests me about gold and why I continue to talk about it is people who've pushed gold over the years, your Peter Schiffs of the world, have always said, well, look at what this is relative to gold. Look at where the yen is relative to gold. Look at where the Dow is relative to gold. And my initial thoughts when I would hear that, it's like, well, so what? I don't spend in gold. Recently, I've spent in gold. And I mentioned this in another show. Recently, I took a gold coin and I changed it for cash and I spent it on something, right? Happened to be a handgun, but that's not important. Wow, I sound nuts with this shirt on, especially right now. But I mean, when you look at it from that perspective, gold exists as a currency more so than an asset. And this is to Ken Fisher, comparing it to essentially stock certificates, right? Is that if an apocalypse were to happen, which I'm not predicting, you can't go exchange a stock certificate for milk. Am I wrong on when I say that? Do you guys think that gold is a currency or it is an investment asset?
Yeah, well, if you take it to that point,
that's an extreme.
It's extreme, but it's true, right? Mm-hmm. And I think we all hope and believe we're never going to get to that place, right, where we're going to need a bunker, a food supply, a water supply, and gold and ammunition.
Yeah, I don't believe that, for the record.
Okay. Going through the process. People do, but that's part of the value of that, because at the end of the day, it's growing up, and there's going to be a complete nerd alert. I was a big coin collector and really got into it, and I'll tell you how it started. So Canadian dollar used to be worth more than the US dollar back when I was 12, and I would ride around my bike and go to all the mom and pop stores and say, hey, I'm going to an Expos game. Do you have any Canadian money? And I was a kid with a baseball cap on. They give it to me. It'd be like $10-$20. I take it to the bank, make 7%. Get American money and ride my bike to the next store and do it. So I can make like, 10, 15, $20 in a day. And so until, the currencies got back into balance. But along the way, silver prices got absolutely exploded, and any coins that were made before 1964 had silver in them. So I do the same thing. I have about $25 in a bankroll. Go to the bank, get rolls of quarters, pull out the quarters, sell them to the silver dealers, and then replace them and do the same thing. It's a long way of saying that either one of those things, at the end of the day, I was never going to lose on. Right? I still had those coins, or I still had the currency. It just happened to be in different countries. So it was a safe arbitrage for me to be operating in. I think part of that safety of gold falls into that category is at the end of the day, you can spend it, right? You can, you're not buying, a JPEG of something that, you thought was really cool because, that may well not do very well, or you're not buying, et cetera, right? It is a precious metal that has a stated value to it. At any point in time, you can trade it for something else. I don't know if you guys are going to take my, my wine collection, which I don't have, and let me get, milk for it, because it's not fungible. Gold is always going to be fungible, and that's part of the appeal.
So just to some of the people watching, because if you grew up in Chicago, the notion that you go to a store and ask for Canadian dollars is absurd. Where Art grew up was in Boston, right?
Burlington, Vermont. So it was very close to the border.
That's what I was about to say. Like when I went to Maine and went to Algonquin, Maine, I was completely blown away that there are towns in America that are French Canadian towns, essentially. And the menus are in French, the street signs were in French. Yeah. And I was like, I'm in Maine, Jesus Christ. But so I think people in the rest of the country, it blew me away that there would be stores that would have Canadian dollars. And that's amazing to me.
When you drive into Maine or into Vermont, the welcome to Vermont sign is both in English and in French. So it just shows you how close we are to the border.
Bobby, would you have known that there's towns in America that are French Canadian towns? Yeah. Yeah, it's pretty crazy.
I wouldn't have known that. I didn't know that today until you guys just told me. I do know there's Chinese American towns. City of Industry, California. If you go there, the signs are actually written in Mandarin larger than they're written in English.
Wow.
It's not close to China, but I think they might have a large Chinese population. That might be why they do this.
Vancouver's 35% Asian, right?
Yeah. And even in Little Italy in Chicago back in the day, signs were not in Italian.
No.
My father always said that he would never lose his accent, and he never did. I think it was laziness. He said it was deliberate. But he would go around in Little Italy on the west side of Chicago, and he didn't have to speak English, not a word of it, because the bank spoke Italian, the grocery store spoke Italian, the bus driver spoke Italian.
I still go to Little Italy, but it's not the same.
No,
even 30 years ago, you'd go there and be, hey, how you doing? Hey, how you doing? I felt so at home. And now it's like tourists.
Not like that anymore.
It's not even that Italian. Wait, it seems like we got off markers there for a second. Well, let's get back on. Bob.
Yeah. So I was going to ask you, looking at 2024, what would you avoid? You obviously have sectors that you think will perform. What would you avoid? Do you think there's an AI bubble?
I think there's an AI bubble. I think we've gotten to the point where we had this exuberance last year. So anybody that mentioned AI in their earnings conference call got rewarded for that. This is the year where there's going to be, show me how you're going to monetize this. And I think that's already started, right? So obviously the incumbents have already shown us how they're going to monetize it. Microsoft is charging for it. Alphabet is making their search better for it, and we'll sell more advertising because of it. NVIDIA is able to sell a lot of chips. AMD is going to follow along with that. But everyone else is going to have to prove out that there's actually not just a productivity gain, but there's money behind this before they get any more sponsorship. So I think there is a bubble. The good news is it's not a bubble like the .com bubble where 860 companies came public and just put .com at the end of their corporate name and didn't have a business model. These are largely incumbent companies that are going to use this to make them more productive, but we have to see that reflected in earnings growth and how that gets monetized. So I think that's where we see some tempering of that excitement. And maybe we're starting to see that a little bit now. I think the other things to be looking out for is I think there's a significant catch-up trade for the underperformers. That's not unusual. You've had a big year and a lot of laggards. So your point, energy, financials, healthcare. But the small caps, the gap between small caps and large caps has never been larger. There's a reason for it. But if you go back on a 2-year run and say, okay, what's the difference between the S&P large cap and the S&P 600 small cap? That gap hasn't been that wide going all the way back to .com. So I think mean reversion happens there. We started to see it in the Russell 2 towards the end of the year, but I think that continues to mean revert. Something that they're less affected by is interest rates, right? S&P 500 largest companies in America, low interest rates. They filled up their treasuries. They issued a lot of debt. They weren't really affected by higher interest rates. That's why that long and variable lag maybe never hit them. But as interest rates start coming down, and we're down 100 basis points now on the 10-year, that helps. That goes from being a headwind to a tailwind for the small caps. I think we start to see some outperformance. I wouldn't be surprised if the Russell 2 outperforms the S&P in the first quarter this year.
So quick follow-up on productivity and AI. And actually, I find it funny that we haven't seen a bunch of startups with AI in their name.
Right.
Or you just kind of take advantage of the dot-com bubble, put AI in your name. You say that you use Chat GPT to order from restaurants, and then you just go public. But maybe we'll see that in 2024. Technology doesn't always lead to productivity gains. An example would be smartphones. I mean, if you look at looking at the Fed's data on productivity, when smartphones came into be, the iPhone got launched, and then we got the Android. You didn't necessarily get a productivity jump, although the internet itself, obviously, huge productivity jump. Right. Is AI a real productivity jump, or because AI is likely to replace white collar first, will we not get as big a productivity jump in your opinion?
No, I think it's going to be a massive productivity jump, and it's going to be very much like computing speeds. I think if you looked at processing speeds and did an overlay of how our productivity gains were from there, it's just natural that we're going to get better and faster. And yes, it may take some jobs away, but certainly, so did the invention of the automobile, right? So at the very same time we look at this, I have to believe that it increases our productivity. It's just, what it is just much faster processing speeds, and as we sort of, went from the late 80s and having mainframe computers to having personal computers, and then they get faster and a better memory and better processing skills. The same thing happens with AI. It's just, at a 2 sigma or 3 sigma level higher. So yeah, I think we're going to see and I think it's going to happen a lot faster, right? So this has been something the company's been working on for 10 years, and all of a sudden it just came into existence last year in our lives. But I think it continues to become a bigger part of it.
So to follow up for that, because I've been arguing, back in the 80s, we all give Paul Volcker credit for slaying the inflation dragon or whatever. I think the advent of the internet started around the mid 80s, and the deflationary pressures of technology was this huge. It increased people didn't even know how it increased our life by keeping inflation down, regardless of the amount of money they spend. I think AI has the power to do that. We just said increases in productivity right here. Are you also saying that on the hierarchy of what could keep inflation down over the next 5 years, AI has the power to be a major factor?
Yeah, well, I think the major change in inflation that we've seen already has come from fixing supply chains. It has nothing to do with monetary policy.
Amen, brother.
The second major improvement in inflation is going to be increase in productivity. And when you think about, in simple terms, GDP is just our workforce population and productivity. That's it. Bottom line. Just take that equation and say, how are we going to increase our productivity? And I think getting better technology, the implementation of better technology just does that. And that drives down prices, and that's disinflationary. And to your point, you're right. I think that, and I don't know if we talked about this last time I was on, but I was looking at this came from a client. It was like, hey, I've been doing this for a long time, and you guys used to refer to long bond. How come you don't do that anymore? I was like, well, we actually ran a surplus in this country for a minute, but it was during the Clinton administration, so they stopped issuing the 30-year, and then everybody focused on the 10-year, and then the 30-year came back, but everyone's focus turned to the 10-year, and that's all we talk about now. When I started the business, the 30-year was the only thing you talked about. Well, the reason that I mentioned that was that was right in the middle of the internet experience, right? That was one of our most productive increases in the period of time. It started in the middle 80s, but really, hit a crescendo in 1998, and that happened to be the year that we were so productive. We ran a surplus. It was disinflationary. I think that's going to. I think AI helps with that, right? And as much as monetary policy is slaying the dragon, and Paul Volcker days were a lot different than our current Fed, where there's not a Fed president that doesn't have an unexpressed thought to the public, which I think does more harm than good. In Paul Volcker's days, the only way you found out what they did to monetary policy was the next day. Manny, Hanny, and Chase up their rates. It was like, oh, they just went up 250 basis points. The Fed must have raised rates by 250 basis points.
And they rolled you over in the bond market.
Right. Exactly. that and the money supply numbers that came out on Thursday were the two things you had to look out for. And if I told that to somebody, on our bond desk today, they'd look at me like I had antlers. I was like, "What are you talking about?" It was like, "Of course we know."
Did you say look at me like I had antlers?
Yeah,
right. That's pretty good. I like that.
So to the extent that correct. One of the times that we've had explosive productivity, and certainly, walking around and staring at your phone isn't productive, but computing speed, processing speed, and our ability to, transact business at a faster level, just closing trades at a faster level, all those things that increased because of technology increase our productivity. And I think that's what we're going through right now. Now, will that happen in 2024? Gradually. I think it happens a lot faster than the 8 or 10 years it took for the internet really to take hold and make us more productive. But I certainly think it's happening at a rapid pace, and I think that's one of the things that becomes disinflationary and helps us get at least closer to what the Fed's symmetric goal is.
Probably
So
you wanna
both
ask
an
one more
interest,
question, or we
yeah,
got-
just both an interesting and a scary thought that somebody I respect told me this weekend. He said that he was listening to a speech by some computing genius somewhere, and that particular person said that quantum computing is coming rapidly, and the country that controls or gets there first in terms of quantum computing controls the world for the next 1,000 years, because it can allow that particular country's economy to leap so far ahead based on the computing speeds that there's no catching it. And obviously China, the US, are working on it frantically. So it'll be interesting to see. And that's the thing that I worry about. I don't necessarily worry about it with AI. It'll just be interesting to see what that does, because it certainly, to me, doesn't infect the trading landscape as much, or the investing landscape, because it's large language models. It's not math models. So like computing is math, AI had to be programmed by people into languages. So it's a slightly different discipline that's coming at AI. So it'll be really interesting to see. And I agree with you. It is going to be the productivity miracle that maybe in 2025 helps slay inflation without the Fed needing to do anything.
Right. And if it was something that we're using for trading, imagine if we used a large language model, programmed in what the market was likely to do in 2023. And there was, at that point in time, there was at some point in time a story on Bloomberg that there's a 100% chance of recession, and everyone's prediction, everyone would have been blown up if we had actually used artificial intelligence instead of using sort of common sense and boots on the ground.
Yeah.
You want to call it, Bobby?
Yeah, we're done.
Art, tell the people where they can find you to interact with you. I know you're on Twitter, right?
Yeah, I'm on Twitter and LinkedIn, and I just reposted what Bobby sent out, and I will do it again. And it's always a pleasure to join you guys. This is the only time I'll ever be in front of a camera without a tie and a suit coat on.
Yeah,
it's a joy, isn't it?
To wearing a T-shirt. Do you own any T-shirts?
I got one right under your shirt. Yeah.
No, they don't.
No, not that kind. No.
He didn't say undershirts. He said T-shirts.
Do I? No, I don't. No, I don't.
I mean, do you wear a V-neck T-shirt under that?
I do. Yeah.
So do I when I wear it.
You can't get a guy who used to trade currencies when he was 7 to wear a T-shirt on a financial show.
Well, it's just like
he basically traded currencies when he was 7. This is
how
matched we are here mentally.
He was from Brazil, and his start was when they were having a currency crisis. He and his buddies would go on their bike and trade for U.S. dollars to the tourists. And he was like 10 years old, and now he's a sofa trader. But anyway, we could go on all day. Good to see you, Art, as always. If you're ever in Chicago, you would come to my restaurant. We'd have a great time. I think you and I have a lot of history. We could have a lot to talk about.
Yeah, absolutely. And as a matter of fact, and I was going to bring this up at this particular show, but there was one point in time where you had the non-farm payroll guesses, and you got a burger at your restaurant. And I think I came the closest, and I never questioned you on it. So I think you owe me a burger.
I think you're right. I thought we agreed to it. I owe you dinner.
Well, at least a burger.
Come and collect.
I'll pay for the beers. All right.
You pay for the beers.
I'm looking forward to it.
Thank you very much.
Hey, those of you guys that watch this show, next week we start at 4 p.m. Eastern, 3 p.m. Central. That will be a permanent time change for the live show.
Thank you.
Art, thank you.
Thank you.